Let us have an understanding of our transaction before we proceed for the next question. Let us say that there is a person called Mr. A, and let us say that he wants to purchase 10 gram gold at the end of the year. Let us assume that today's date is 1st of January and he is considering to purchase gold at the end of the year, that is on 31st of December. Let us assume that today the price of 10 gram gold is an amount of, let us say, 50,000. I am just taking a random price. The rate of interest in the market is 20%. Now Mr. A is considering that let me enter into the forward contract or futures contract to buy 10 gram gold at the end of the year. He is approaching to, let us say that's a Mr. X for entering into the transaction for purchasing 10 gram gold at the end of the year. Now my question to all of you is that what is the minimum price that Mr. X will offer to sell gold on 31st of December, full stop, considering Mr. X is not a speculator. I want you to write answer of this question in the chat box. So we understand that the answer of this question is 60,000 because we understand that Mr. X will make sure that if at all he is not a speculator, then in that case he will not rely upon purchasing of the gold at the end of the year. So today only he will buy the gold for 50,000. Keeping the gold for 1 year will have a carrying cost, opportunity cost at 20%. So that comes to 10,000. So 50 plus 10, that comes to 60,000. This is the way, he will quote the minimum price. Suppose Mr. X is quoting the price of rupees 61,000. This is the price that Mr. X is quoting to Mr. A. Now my question to all of you is that whether Mr. A will enter into the forward contract with Mr. X or not. Write your answer in the chat box. So we understand that Mr. A will deny that no, I am not interested in the transaction. Why? Because Mr. A also has done his own homework before going into the market, that what is the price of the gold today, what is the rate of interest, and accordingly he already knows that 60,000 is the price that he will be having, a cost that he will have if at all he is purchasing the gold right now and he is holding it for 1 year. So basically he was looking for some speculator in the market who may give a quotation for less than 60,000. If at all somebody is expecting that price of the gold at the end of the year will be, suppose I am expecting it to be 56,000, then I may give the quotation of 58,000. Then in that case, Mr. A would be interested in entering into the transaction because for him there will be a fixed price to buy the gold, that is 58,000. This is the way we understand is that the transaction that can be entered upon and the price of the futures contract. Right now we can say that theoretically the futures price of gold will be an amount of ₹1, that is an amount ₹60,000. Why? Because from Mr. A point of view, he is ready to pay maximum amount of rupees 60,000, and from Mr. X point of view, he will give the quotation of minimum 60,000. So we can say that the theoretical forward price or the futures price will be equal to spot plus interest. What is the spot value of the commodity? 50,000. What is the amount of the interest at the rate of 20%? So 50,000 plus 20%, that comes to 60,000. This is what we understand is a forward / futures price of the underlying asset. Dear students, there will be a few adjustments that we are supposed to make over here. Which are those adjustments I will be explaining to you later on. For the timing, just understanding this basic formula. And based on that, we are doing this question. On 1st of January, a situation as under is prevailing. Spot value of the commodity is 50 rupees. Rate of interest is 20%. Time period is 1 year. 1 year forward price or futures price of the commodity is 62,000. You are required to answer following question. Mr. Amitabh Bachchan believes that in above situation, an opportunity of arbitrage exists. So he enters into the transaction of borrow rupees and invest in commodity. Calculate the profit or loss that he is likely to make in this case. So we are required to answer that what will be the profit or loss that Mr. Amitabh Bachchan will have if at all he is entering into this transaction. So write down answer of the question. On 1st of January, Mr. AB will enter into following transactions. First, borrow rupees 50,000 at the rate of 20% for 1 year. Second, purchase commodity from spot market. Third, enter in futures contract to sell commodity at the rate of rupees 62,000, full stop. With paragraph write down. On 31st of December, Mr. AB will have following position. 1, liability of repayment of loan rupees 60,000. In bracket write down 50,000 plus 20%. Second, holding of a commodity, holding of commodity maybe gold or something like that. Third, holding of a forward contract to sell commodity at the rate of rupees 62,000. Full stop. With paragraph write down. Mr. AB will have following position, in that sale value of commodity 62,000 less repayment of loan 60,000. So difference is 2,000. Now I have a question to all of you. Please write your answer in the chat box. My question to all of you is this. Suppose on 31st of December, spot value of commodity is rupees 61,500. What will be profit or loss to Mr. AB? That is my question. For transactions entered upon on 1st of January. For these transactions which have been entered upon on 1st of January, what will be the profit or loss to Mr. AB if on 31st of December the price is 61,500? Write your answer in the chat box. Now friends, importantly, answer of this question will be 2,000. Why 2,000? Because you can see that, say, importantly, I have dictated to you that a forward contract is entered upon to sell the commodity at the rate of rupees 62,000. So once you enter into the forward contract, then in that case, what is the spot rate is not required to be considered by you. We understand that, say, irrespective of the spot value of the commodity, you will get a fixed amount of rupees 62,000. So we understand that, say, irrespective of the price fluctuation at the end of the year, you are going to make a firm profit. That is the reason it is given a name as arbitrage. What do we understand with the term arbitrage? In simple language, arbitrage is indicating a theoretical situation that does not exist practically. In a way that, say, what will happen if at all a situation like this is prevailing? As per the discussion that, say, we have just made, we understand that, say, the forward price should be spot plus interest. So the forward price should be 60,000. If at all the price is other than 60,000, then in that case the traders will enter into the transactions in such a way and they will get the price into equilibrium. On 1st of January, for this commodity, the price should be 60,000. If at all the price is more, 62,000, then what everybody will do? On 1st of January, everybody will enter into the transaction to sell commodity, sell commodity, sell commodity. If everybody will go short, then in that case what will happen? So the price of the commodity will fall down with the increase in the supply, and the price will fall down to rupees what? 60,000. That is the equilibrium price. So arbitrage is indicating a theoretical situation that said this kind of situation does not exist practically. That is what we understand. So write down arbitrage answer, that is